the fear over tariff inflation is basically, perhaps they would call it TDS, but not Trump derangement syndrome, tariff derangement syndrome. So far, the sample size of one piece of evidence actually does support that AI is eating the economy, and that actually the capital expenditure on information processing equipment has added more to GDP growth than personal consumption expenditure. Powell's term ends in Q1 or Q2 of next year, so it's basically less than a year left. And President Trump is going to instill someone who is either a mega dove, a perma dove, or more likely a Trump loyalist who is going to give Trump what he wants, aka rate cuts. Like, how come the 2-year treasury, the 3-year treasury, how come that isn't at 2% or 1.5%? This episode is brought to you by FiscalAI, the fastest growing stock research terminal on the internet. You'll hear more about Fiscal later in the show. Let's get into it. Got a very special episode of Monetary Matters today. So much to break down, lots of news. We got the GDP figure, we've got a lot of earnings reports, and we had the Federal Reserve meeting, lots of news on tariffs as well. I'm joined by my friend and business partner, Max Wiethe. Max, great to see you.
It's great to see you too, Jack. Why don't we just start off with the Fed meeting? Obviously, no change in rates, but we did get some interesting tidbits of how the Fed is feeling from the press conference today. What did you make of it?
Well, looking at short-term interest rate futures, the rates are somewhat higher than they were. So I think you can say that this is a hawkish meeting. And that is, I guess, a little bit of a challenge to the equity market when interest rates are going to budge up a little bit. But you just had some enormous earnings just reported, Max, from Microsoft and from Facebook and Meta, saying something to the effect of narrowing their guidance of $66 to $72 billion they're going to spend this year, up $30 billion year over year capital expenditure. And that in 2026, we see we can plan that we continue to aggressively pursue opportunities to bring additional capacity online with AI and business operations. So, Max, normally we would talk so much about the Fed, but I'm just think of, this chart that I saw on Twitter, which is basically saying that AI is eating the economy, and that actually the capital expenditure on information processing equipment is greater, has added more to GDP growth than personal consumption expenditure, aka the US consumer. So I think actually, Max, we have seen a mild softening of consumer demand from good levels to fair levels. Definitely not recessionary at all. Like the US consumer has been on fire for 5 years in a row. So it's not a shocker that things are finally cooling down. But you're seeing seeing investment, particularly in AI and AI CapEx, fill the gap, and in some instances more than fill the gap. So, Max, I mean, the US GDP figure was out, and I think, Max, that when the Q1 figure was recorded, I believe negative 50 basis points. I joined many other economic thinkers and economists in saying that it was nowhere near as bad as it sounded, because the net exports was a huge drag. Basically, there were tons of imports into the country, and that led to a strongly negative net export figure. That's a drag on GDP. Now, and of course, they were front-running tariffs. Now that the tariffs are in place somewhat, the imports have collapsed. So that leads to a significantly less negative net exports figure. So that hurts GDP less. So the GDP figure today of a 3%, it appears rosy, but it's in the same way that the last figures was nowhere near as bad as it seems. I would not say that this GDP figure was nearly as good as it seems. And actually, private demand on final purchases or final sales was up 1.2% in real terms, which was the lowest reading since Q4 of 2022. So I'd say I'm not an expert on GDP reports, but certainly not a super strong GDP report. Nevertheless, inflation remains above target and the unemployment rate remains low. And so Fed Chair Powell's message today was, hey, I'm hanging steady here. And, we're the interest rate right now of 4.4% is moderately restrictive. And that is the appropriate stance when on one leg of our mandate, we are above target inflation, and we are perfectly at where we want to be on the labor front. So that's just where it's got to be. And we had two dissents, one of them being Bowman, the other one being Vice Chair Waller. And so that is quite substantial. You don't definitely normally see that, but Powell appeared to take it in stride. So those two members of the FOMC wanted to cut interest rates, but the board decided, nope, it's not time to cut. And so actually the market pricing now is that for the next September meeting, there's a 55% chance that they don't cut it all in the September meeting, even though they have basically two pieces of data, because they don't have the, in August, it's the Jackson Hole meeting. So they don't have a decision there. It's kind of just an economic conference, a symposium. So yeah, the market took it as hawkish. I think marginally the verbiage was hawkish, but I think not a lot had changed from the last meeting. That basically inflation is still above target, and the labor market is still solid. Someone asked about, oh, but jobs are going down, like net job additions, and Powell said, actually, that's true, but also the break-even rate, that is the level of jobs you have to add in order to basically tread water and not add jobs because people are laid off and quit and the likes, is also going down. So he said demand for labor is going down, but also the supply of labor is going down as well. So it's kind of in this steady state position. So I'd say things are unchanged, but the thing that has changed is the market was expecting a little bit more dovish, and they just didn't see it.
Okay, now what about inflation? I think Chair Powell did mention that we saw tariffs show up a little bit in the inflation data, but not to the level that we have confidence in how tariffs are going to impact inflation. So do you think the jury is still out on tariff impact on inflation, and that's why we got another pause today?
Yeah, what Powell said effectively is that he'd seen some moderate level of inflationary pressure from the tariffs, but that most of it had been absorbed by businesses. Tariffs are a tax and they are a cost, and the government of China does not pay tariffs. It's either the companies that make it in China, whether they're Chinese or American, pay it, or the American consumer pays it. And Powell so far said that basically it's mostly been businesses, and there's been relatively little pass through in the prices. Now, the Federal Reserve's measure of inflation is PCE, personal consumption expenditure, the price index, and consumer price index is consumer. So I think CPI wouldn't really be affected at all, I don't think, if 100% of the price increases were absorbed by businesses. Maybe that's true for PCE, but to be honest, I don't know. So Max, just to give the people the stats, like the most recent PCE reading for headlines, so including food and energy, was 2.7% year over year, and for 2.3% for core, so excluding food and energy. However, looking in this Q2 report, which I guess looks at the entire quarter, the headline was up 2.1% and core was up 2.5%. Also, Max, technically the price index for imports was down 0.8%. And I believe these figures, Max, are quarter over quarter annualized figures for the previous three things. So technically, you could make the argument that tariffs have caused prices to go down. That is the correlation so far with the sample size of one. I don't expect that to be true. There are definitely folks and economists in the Trump administration who have been and probably will continue to make that argument that actually import prices are going down even as we have these tariffs. So that basically the fear over tariff inflation is basically, perhaps they would call it TDS, but not Trump derangement syndrome, tariff derangement syndrome. So far, the sample size of one piece of evidence actually does support that, but I don't think we're anywhere close enough to reach a firm conclusion, like anywhere close at all. And I think Powell and most people are in the same boat.
Now, what about there was an interesting question about companies using the tariffs as cover to raise prices on products that are not actually affected by tariffs. Powell actually talked about the previous Trump administration, how washing machines were subject to a tariff, but dryers were not. Yet prices were raised on both in lockstep. And Powell basically said, look, companies are going to use whatever they can to raise prices. So even if it's not showing up in the data, this tariff derangement syndrome might actually be self-reinforcing in it causing prices to go higher. Do you think that that is what we're going to see?
I think that's very possible. And you could make the argument that even if the huge demand side stimulus or the supply side snarls of like 2020 and 2021 didn't cause inflation, that people are reading reports about it every day, and it gives companies, it gives them license in order to raise prices. And that is basically the psychology of embedded inflation expectations, which the Federal Reserve is so determined to avoid. Powell, by the way, said that short-term inflation expectations had risen, but long-term inflation expectations remained anchored. Funny you mentioned washing machines, Max. There's an infamous paper, I believe in 2018, about the impacts of tariffs on the prices of washing machines. To be honest, I haven't read it, but I think that's probably is what Powell was citing, the washing machine economic literature on tariffs. But what I have read, Max, is Whirlpool, I think the biggest producer of tariffs, actually wrote down that tariffs, I don't have the absolute cost, but in terms of their EBITDA margins, they said tariff would hurt them by 250 basis points, so 2.5%, but that would be offset by a 2.5% pricing actions as well as supply chain actions. So pricing actions means raising prices, aka on the consumer, so inflationary, and supply chain actions means squeezing the suppliers, which would be deflationary and not inflationary. So you either squeeze the consumers or you pay it yourself or you squeeze other producers in the supply chain. So I think that you have definitely a scenario where, yeah, companies are not going to be happy to eat the cost forever. And I think they will do a price hike. The question is it going to be a one-time price hike or lead to sustained inflation? Like the the inflation of the price hikes of 2020 and 2021 turned out to not to be one-time price hikes. They turned out to be embedded, and they led to a cascade of price raises across the supply chain and across the entire global economy as well. But I think Powell basically said, and I'm pretty much quoting, that it is a reasonable base case that the price increases we see from tariffs are going to be a one-time price shock and not lead to sustained inflation. However, the Federal Reserve should be prepared that it could be sustained inflation, and that's why they are keeping their foot on the gas pedal by keeping interest rates high, and that they basically don't want to cut too soon before the price hikes actually come there and it gets inflationary. So, everyone and their mom wants to have an opinion about the Fed should do this. The Fed is making a mistake. I really do not value my own opinion that much. In order to preempt your question about is the Fed making a mistake, I think you really can make a valid argument for they should be cutting, they should be hiking. President Trump's argument that the Fed should be cutting, it is not a ridiculous argument. The thing that's controversial about it is it's not the argument, it's the man who's saying it, the president, that because they should be central bank independence. And Fed Chair Powell goes out of his way to not comment on fiscal policy or the president really at all. Historically, that has been a two-way street, and the president respects that. Obviously, in the interim, Max, between our last conversation, we had President Trump going to the Federal Reserve to inspect the supposed cost overruns of the build out of the Federal Reserve. I believe $2.5 billion. What a photo op. It looked like it was made by AI. Powell was asked about that. He, of course, demurred and gave the polite no comment. So I think, Max, that, yeah, reasonable base case is that its prices will go up, but it will be a one-time price shock. In other words, it will be transitory. Of course, that the Federal Reserve is reluctant to say, oh, it's go transitory again, because they said that in 2021 and it wasn't. FiscalAI is the fastest growing stock research terminal on the internet. They combine a modern user experience with complete financial data on all stocks globally. Not only does that include 20 years of standard financial statements, but they also track company-specific segments and KPIs on over 2,000 companies.
That's right, Jack. Want Amazon's cloud revenue? They've got it. How about Spotify's premium subscribers? Or segmental analysis of the different luxury verticals at Hermes? This is data that other platforms just don't track, even though it's the data that really matters. They've got all of that and literally millions more data points. And unlike legacy equity research platforms, FiscalAI's data is real time, so it's updated within minutes of company earnings reports.
And Max, there are so many more features, including earnings calls, transcripts, financial modeling, best-in-class charting, portfolios of super investors like Stan Druckenmiller and Chris Hone, and they even have an easy-to-use data API so you can export data and build your own models in Excel. FiscalAI is changing the way investors conduct equity research, whether it's individuals like us or institutional investors like Van Eck, who have their whole research team on the platform. But don't just take our word for it. Sign up for a 2-week free trial at fiscal.ai/mm to see for yourself. And if you upgrade, our link will get you 15% off your first year on any of their paid tiers. Again, that's fiscal.ai/mm. Let's get back to the interview.
Well, it's funny because in between meetings, we often get data points that move around the pricing on interest rate expectations moving forward. And we did get some data points this time in between meetings, but it seemed more like these statements from President Trump were having a greater effect on people's perception of what's going to happen next with interest rates. But interestingly enough, this meeting was a pleasant reminder to all of us that Fed Chair Powell does not actually set interest rates. It is a vote of all of the members of the committee. So it doesn't really matter who is the Fed chair. It matters what the committee wants. And there is somewhat a tradition that people vote with the chair. But we saw some dissent. It's not common to see a lot of dissent, but 2 members of dissent. How common is that to get 2 people not voting with everybody?
It definitely happens fewer than once a year. There are eight meetings, and I can't give numbers on it other than rather uncommon. But yeah, definitely the type of thing you see maybe one every 3 to 5 to 10 years. But yeah, definitely not every meeting and definitely not every year. So it was rare. And I think even though, yes, Powell's vote doesn't count as much as counts just as much as everyone else on the FOMC, he is a leader and his responsibility is not just a figurehead. He is shepherding the other board members through their decision, not just at the meeting, but before the meeting. And I actually heard Powell at a conference, I believe last year, say that he has a 30-minute meeting with every single FOMC member the Friday before the meeting. So that would have been 5 days ago. So he's weighing consensus in the same way Mike Johnson or formerly Chuck Schumer. They are always talking and leading their colleagues to where they want to go. Powell and the Fed chair man or woman does run the show, even though, yes, their vote counts just as much as everyone else. I also, Max, and I guess I'm embarrassed that this thought only occurred to me so recently, but I'm like, okay, if Powell's term ends in Q1 or Q2 of next year, so it's basically less than a year left, and President Trump is going to instill someone who is either a mega dove, a perma dove, or more likely a Trump loyalist who is going to give Trump what he wants, aka rate cuts. Like, how come the 2-year treasury, the 3-year treasury, which of course prices in forward rates, how come that isn't at 2% or 1.5%? And of course, the trade there would be like as for the yield curve to steepen, like short-term rates to go down and the long-term rate to go up, because inflation expectations could go up as well if interest rates go down. So I guess that is a question I've been having. Like, how come this isn't a great trade of just like owning in huge size like 2-year or 3-year treasury futures, or owning a call option on those that interest rates go down. I think the reality is probably a lot of it is priced into somewhat of it is priced into forward markets. And also probably the implied volatility is high. It's one of those things, Max, where maybe the trade on paper looks so easy and simple, but actually implementing is different. Like, I just spoke with Johnny Matthews, who I'm going to be interviewing tomorrow, a former Brevin Howard trader, great thinker, great macro trader and thinker. And he brought up that space of like, putting on the steepener. It sounds so easy, but you're paying 50 basis points. And in a forward swap, you're paying 60 basis points. It really has to, for you to break even, I guess it has to, over the course of the trade every year, I guess it has to widen by 60 basis points. I don't know if that's exactly right, but the P&L is often different than how it looks on the chart.
I think it's also would be quite unprecedented for that to occur, even though it does appear likely that that is the person who's going to be put in. Again, we have the fact that the chair does not set the rates. It is done by committee. The other side of it is it would be completely unprecedented for this to occur. And the bond market prices are not set by, as much as we like to think that these discretionary macro hedge fund managers are the rulers of the world. They actually are not. There's much more slow moving people who actually are the biggest whales in the bond market, and they're not paid to make those types of bets. They're paid to just follow along and hedge their risks, not to bet on these types of unprecedented things happening. So that would be the reason. And that might mean that it's an opportunity. If it is clear that Trump is going to be putting somebody in who's either going to be a dove or is going to do whatever he wants, then maybe there's a trade there.
And if a Taiwanese life insurance company, if they buy a bunch of duration and that leads to the yield curve invert, it's not like the bond market is telling you XYZ. It's just that there are a lot of old people in Taiwan who just bought life insurance.
Yes, exactly. And I just don't think that those Taiwanese life insurers are betting. They're not playing that game. They're not playing the short-term interest rate future, expectation.
Absolutely. And Max, Johnny, he said that he's a bear on the treasury market. He's a fantastic macro trader, worked at a legendary shop, Brevin Howard, obviously. And I had a huge return personally shorting treasury futures and perhaps global duration like bond markets in 2022. And so that was basically taking the yield curve from 1.5% to 4.5%. Like, it's a huge move in macro. He's now like relatively bearish on bonds as well, but nowhere nearly as bearish. He thinks he's short a few bonds here and there, like expecting the 10-year to go to 5%. Not expecting, but like that's what he's kind of betting on. So again, it's not a big move. And I think like the big macro trade, it can't be short bonds because 4.5% to 5%, who cares? That's just trading. That's not going to make your career, and it's not going to be a big trade. And often, I'd say most of the time, there's not a big trade. But yeah, I just don't know how much more the treasury market could weaken. Treasury volatility has been very low. You just had a quarterly refunding announcement. I don't, that stuff is like Greek to me. But basically, I think that the Treasury is issuing some bills. So it's not like they're loading the gun and issuing tons of 30-year bonds that's going to drown the bond market and no one can buy. And who are the buyers? That's just doesn't seem like it's going to happen. So then the question is the release valve going to be the currency? If if people are always going to be buying duration and the 10 year is not going to be go to 5.5 or 6% or even higher, is the release valve going to be the US dollar? Is the US dollar going to weaken? That to me seems possible. And I think that it's what President Trump wants. He really is openly talking that he wants a weaker dollar. He says, I like the concept of strong dollar because it sounds good. But if you do the math, that basically that's how to solve the trade issue is by weakening the dollar. And Max, the more I read about trade and trade history, and I've got a guest I'm really, really excited about who's like, he's basically like the god of tariffs. And the more I read him and other people, I realize like basically a tariff is basically kind of the same as weakening your currency. So President Trump can do tariffs, and at the same time, he weakens the U.S. dollar, or the U.S. dollar is weakened, and as a result, that will stimulate exports and hurt imports, and that's what President Trump really wants, right? And at least some of his base, the MAGA base, wants is to rebalance trade and have net exports approach zero, so we don't have a trade deficit. And I think that's going to be really hard to do. But I think the Trump administration has seen some small victories so far. I mean, the European Union deal, I never would have expected that to happen. Like basically the US puts a 15% tariff on the EU and the EU puts a 0% tariff on the US. And also that the EU is going to invest $750 billion of not buy $750 billion worth of energy, like oil and gas and stuff. Definitely some of which they would have bought
I was
anyway.
just say, don't they need the energy anyway?
Yeah, they do. So I don't know about that second part if that's super relevant. But it's a good headline, huh? And yeah, so I mean, if the US can tariff the rest of the world and the world does not tariff the US back and the retaliation is zero, I mean, I do not see that as a very adverse outcome for the US at all. Now, of course, that tariff, when I say tariff the world, I'm not suggesting that the tariffs will be paid by other countries. They'll be paid by a combination of companies that produce in those countries, either owned by those domestic nations or US, and US consumers. So it is kind of a consumption tax. But with the one big beautiful bill, you have a lot of tax cuts. Now, some people make the argument, and it was actually referenced in the talk today, that those a lot of the tax cuts in the one big beautiful bill are extensions. So technically, they are not a net stimulus. They are just an extension of a stimulus that already exists. So what was going to be priced into the CBO, the Congressional Budget Office, it was a contraction of those 2017 Tax Cuts and Job Acts going away. Trump just extended those, but that's different than a new tax cut. It's an extension of a tax cut that was going to go away. So Powell said he didn't think that the one big beautiful bill would be that stimulative. Now, if that's the case, then that could be a little bit of a contraction. So, I mean, I do think tariffs, they're going to net like reduce real GDP, either by inflation going up or by consumption going down. I still believe that to be true, but so far the impacts have been moderated, and I think a lot of that is that the actual tariffs have been moderated. But so far we have a deal with the EU. The China deal, I think, in early August is set to expire, but if there's already tons of trial balloons being floated that they're going to extend that another 30-day, maybe another 90-day extension. So I think a lot of the can is being kicked down the road, and definitely it is not like all these tariffs are going sky high all at once. So I also think, Max, a lot of the audience and definitely myself and probably you have tariff fatigue. I think probably everyone has tariff fatigue, probably except for the president. But just because we're tired of it doesn't mean we should stop paying attention to it, because it really does matter.
Yeah, and we have the deadlines coming up. Where do we stand as far as deals negotiated, outstanding deals, new, tariff hikes? Brazil seems to be getting the biggest delta in terms of tariffs going up compared to where they were at the start of this whole tariff hubbub. So my question is, what are the big deadlines that are still coming up, and what are the unknowns that are outstanding?
So, Max, the key date was August 1st, an implementation date of a lot of those tariffs. Again, the 90-day tariffs from 90-day tariff reprieve from early April into early July. Then Trump extended it. The new date was April 1st. That date is 2 days approaching. So with the EU, they basically have a deal. With China, the extension date is like later on in August, but they look like that's going to be rolled on as I just mentioned. So now China and the U.S. are China and the EU are a huge percentage of trade. Then there's the bucket of everyone else. In 2 days, the tariff on Brazil is set to go to 50%. The tariff on Myanmar 40%, Laos 40%, Thailand 36%, Cambodia 36%, Canada 35%, Japan 15%. So that's lower than the April 2nd Liberation Day tariffs. But a lot of these tariff rates are at or above the Liberation Day tariffs. So that would be quite extreme. I think definitely the stock market, and therefore, who am I to disagree with the stock market? Stock market's been right so far about doubting that President Trump would enact as strong and as high of the tariffs that he actually has, that there's going to be a negotiation or going to roll back some deals. Like if there's no deal, I think the market would have a strong negative outcome. But I don't think that's going to happen, and the stock market definitely doesn't think that's going to happen. So either we see huge deals or we see kick the can down the road, a 30-day delay, a 90-day delay. But yeah, I've got no idea. Interestingly, Brazil is a country that has a trade deficit with the U.S. So the U.S. has a trade surplus with the U.S. with Brazil. So that actually, the Brazil is quote unquote a good country. Brazil is quote unquote treating us very not unfairly. They're treating us very fairly. Maybe we're treating Brazil unfairly because we have a trade surplus with them. But I think it's fair to say for political reasons, aka the president Lula is a left wing, and President Trump was a big fan of the right wing Bolsonaro, who I believe now could be in jail. President Trump is protesting that, and I think that is part of the reason why they now have a 50% tariff. Again, Max, this is a point I've made for many months now, is that President Trump's ambitions are in many ways economic with tariffs, but he's also using tariffs to achieve non-economic goals, such as putting pressure on a left-wing Latin American politician who he doesn't particularly care for.
Yeah. And as you said, the market seems to be currently shrugging off these tariffs. What it's not shrugging off is the earnings that we're seeing. So you talked about Microsoft, Meta, these big market leaders, but also Whirlpool. So who are you looking at for earnings? Washing machines, AI, big tech. It seems like you've got all the bases covered. What are the other earnings reports that have come out recently that you've been diving into? And what are the insights you're?
Well, Max, a lot of old school companies that make things manufacturing are paying the tariffs right now, and that is definitely a drag on their earnings. I calculated earlier this month that GM's second quarter earnings, 29% of their pre-tax and pre-tariff profits, they paid in tariffs. So $1.5 billion in one quarter. That's definitely quite steep for GM. Meanwhile, no mention of tariffs in the Microsoft earnings report, no mention of tariffs in Meta. Like, how are how is these huge technology SaaS businesses affected by tariffs? I don't really think they are that much at all. And maybe to the average worker works at a company that is impacted by tariffs, perhaps, but the average dollar invested in the U.S. stock market is invested in a company that is not hurt by tariffs. So to the S&P, I think that maybe tariffs are not as big of a risk as the market maybe thought on April 2nd and early April. Yeah, Microsoft's revenue was up 18%, 17% not including the dollar. Their cloud business is up 39%. Some of that is because of the dollar, 34%, I believe, before currency. And yeah, Meta shot the lights out as well. And Microsoft's up something like 8%. Yes, 7% now. Meta is up 9% as well. These are big companies in the S&P. So I think you could like GM could go to zero and go out of business, and the market cap gains in Meta and Microsoft, I estimate, would probably more than make up for that. So it's just, yeah, AI is eating the economy, and AI capex is going to be a huge boost. Also, there was Kevin Hassett, economist for the Trump administration. He did say some things on CNBC this morning that I disagree with his analysis. Like, he obviously thought it was a very, very strong GDP report. He actually said that it was like Miss July, or so it was like the most beautiful job report ever. Obviously, I explained my own view, but one thing I definitely agree with Mr. Hassett on, Dr. Hassett, is that companies before they were waiting for the one big beautiful bill to pass, so their capex actually was slightly down, and that actually now that the one big beautiful bill is here, and you have bonus depreciation, so companies get huge tax breaks on their investments. Now, setting aside whether that's a good thing or a bad thing, like it probably will stimulate investment. So I think CapEx in the GDP report, I I expect it to continue, and I agree with his analysis that it will go up.
What about some of the other companies that you were looking at that glean a little bit more insight onto the consumer and some of the data that we were looking at from our partners at Fiscal AI?
Max, the first companies to report are nearly almost always the banks and the big banks, and I've got to say the earnings for Q1 from the banks were strong. The earnings from Q2 from the banks were also very strong. And the consumer, in terms of how often is he or she paying off his or her loans, is very strong. And obviously, delinquencies and charge-offs had been raising from these super ridiculously low levels of 2021 and 2022, but they really have appeared to stabilize. And that's true both of high-end American Express customers. It's true of JP Morgan Chase customers. It's also true of Synchrony Financial, a bank that perhaps a lot of customers, people watching this are customers, they don't even know it. Like if you have a rewards card, if you have a TJ Maxx card, or for example, TJ Maxx is not the bank. The actual bank is Synchrony Financial, or uh, and they have thousands of these partnerships across America, and I think their customer is typically a lower than JP Morgan and lower than American Express in terms of credit score and FICO score. And so those delinquencies are down as well. Charge-offs are down as well year over year. So no seasonal nonsense. I will say that for Synchrony Financial, their actual amount of loans is down. So the reason that delinquencies are down is because Synchrony is being more mindful when it is extending credit. So you could say that actually that could cause a recession because banks are pulling back their loans, and that could be true. But the reality is that they are pulling back their loans from a very, very high level. Like credit card growth has been very high for the past three to maybe 4 years. So yeah, the banks are making money from tons of credit cards and nothing systemic. And actually, like the bank capital is so high right now. JP Morgan, that like bank analysts are complaining. They're like, "What do we do with all this capital? Like, I guess we want to do dividends and buy back our own stock, but." Jamie Dimon, CEO of JP Morgan Chase, is complaining because the stock is so richly valued and he doesn't want to buy back his own stock at three times book value. So I will say, Max, that actually I do remember, I think from Sheila Bair's book, Bull by the Horns, that in 2005 and maybe 2006, you did have some people saying the banks are so well capitalized as well. So just because everyone's saying it doesn't mean that it will be true in 2 to 3 years. And obviously, the world could fall down. No one knows, but yeah, it appears that the banks are doing very strong in terms of consumer credits. In terms of commercial real estate, I'm not seeing the delinquencies. I've been interviewing people for literally 4 years, Max. I remember a guy, very, very well respected short seller, great guy. I'd love to interview him. No, I never have, but literally in the fall of 2020, he was talking about commercial real estate and this doom loop that would happen. Admittedly, the fundamentals in offices were weak for a very, very long time. But the commercial real estate, they kick the can down the road, and delinquencies are they're not super high, and they're definitely not high enough to be a systemic risk to the banking system at all. I am going to be interviewing someone, Bill Moreland, who actually says, "Okay, Jack, yes, if you look at the banks, investor presentations and the reports, and even their SEC filings, that's what you're going to see." But basically, like he refers to bank investor earnings press releases as what is it? Basically advertisements for the stock. Like he's actually looking at the call reports, which is reported gathered by the FDIC, and I definitely am. I've only read. I barely know how to read those things. Those are beyond my skill level, definitely. So he says that actually some banks are hiding some pretty ugly things. So I'll be speaking to him later in August to get the alternative view. But yeah, from my not very deep analysis, I think the banks are doing quite fine.
All right. So you talk about Bill Moreland. We've got Johnny Matthews coming up tomorrow. What else can we expect for Monetary Matters listeners?
On Sunday, so early August, my interview with Michael Howell is going to go out. I also interviewed the general secretary from the Financial Stability Board, who is basically calling out, pining to the alternative asset managers, aka private equity and private credit, for more disclosure. Like the Federal Reserve and the European Central Bank and the bodies that govern and coordinate with them, they all have access to like huge levels of bank data. There's lots of people from the Federal Reserve and other regulatory agents like at JP Morgan, Bank of America, and the European equivalents But when it comes to Ares and Apollo and all these other alternative asset managers that are non-banks, it's just the Wild West. And I don't think there's really a lot of data at all. So that's an interesting interview. And then I'm interviewing this professor who I've been nicknaming the God of Tariffs. Been reading some of his books. They're behind me. So that should be good as well. Max, I want to take a sec just to talk about like FiscalAI, and I'm really glad that they are a partner of us, and I'm confident that people are going to like the product. I think they're going to like the value that's being delivered. I think they're going to like the price at which it is at for most people. And yeah, you can do really cool things. And there are lots of data platforms where you can find revenue and earnings, but like the actual fundamental business drivers, the type of things that probably the CFOs and CEOs and the C-suites are looking at, you can create them so easily with FiscalAI. And you'd have to do that. You have to have like an analyst who'd pay lots of money to do that normally and do it yourself. And it really is so easy. So, Max, I don't have this chart now, but I'll make it for you later and send it to you. One thing that I've always wondered about and seemed funny to me, and maybe some people in the audience agree, is like, why does Shake Shack appear optically cheap on a price to sales ratio, price to earnings ratio, but Wingstop has this valuation of 100 times earnings? And I'm not saying Shake Shack is or isn't cheap. I'm definitely not saying that Wingstop isn't expensive. Wingstop is an expensive stock, up like 20% today, by the way. But I think the fundamental reason, from talking to an analyst as well as just looking into the business, is Wingstop is like McDonald's in that it has a high franchise percentage of businesses. So basically, a franchise is like just a license to print money. And if I have a license and you're my franchisee, you do all the work, you take all the capital expenditure risk, and I basically you just send me a check every month or every week, whenever. It's a very good business. Whereas the running a restaurant is famous for being a very difficult business, even if you have a lot of scale. So like you can look at Shake Shacks, and I love the Shake Shack product, by the way. I've never had
I know that.
Wingstop. Yeah, that the sales from company owned stores is very high and dwarfs the revenue from licenses and royalties. Meanwhile, for Wingstop, their license, it's the exact opposite. Licenses and royalties are most of the stores coming from franchises, and their company owned store is a fraction. So you can both look at that on an absolute basis, and then you can also divide them. And so you can look at license and franchise revenues as a percentage of total revenue and compare it from Shake Shack to Wingstop. And I guess for people who've been a veteran of the hedge fund industry, like they've been doing this themselves, build out their own APIs for a while. But to people like me and you, Max, like this has not been available to do like very easily. So I think this is a good thing about technology and a good thing about AI. So I'm just I'm a lover of the FiscalAI product, not just a user. I'm a power user and a lover of the product. And I think there will be a lot of people listening to this who love it as well. People should check it out.
Yeah, and thanks to them, we're actually going to be doing a lot more of these episodes. We don't talk a lot about individual stocks. We do as it relates back to these themes and macro trends that we're discussing. So normally we do these just for Fed Day. For those of you who enjoy when Jack and I get together and we talk about what's happening in the market, you can expect more of these coming out over the next quarter as we dive into a little bit more on individual companies. We're not going to be doing stock pitches and stuff like that, but we are going to be analyzing a lot more of these trends through the lens of individual companies using this FiscalAI product. And I know they are based in Canada, and we do have to say, obviously they're paying us. We are being compensated somewhat for this, but we are enjoying the product quite a bit as we've gotten our hands dirty. And just going back to what you're talking about, the franchise, interestingly, I just interviewed somebody this week for Other People's Money, Donald Zilka of Zilka Investments. And one of the companies we talk about is Nathan's Hot Dogs, is something that they got into. You are a Shake Shack fan. I am a hot dog fan, especially in the summer baseball season. I'm eating lots of hot dogs. So that was a fun one to get into. And as well, I'm very excited on Other People's Money about an anonymous interview I'm going to be doing. There's a big Twitter account that talks a lot about the business side of running hedge funds and investment businesses. If you are on Twitter and you are all interested in those subjects, you might know who I'm talking about, or you will recognize them once this comes out. This person is a fund manager who has had a lot of success at their prior fund, where they were not the founder, but recently actually launched and founded their own hedge fund and have had tremendous success on the investment side, on the capital raising side. And so I'm very excited for that interview. And it will be our first anonymous interview, something you have experience with and have done before. with our pal Citrini, who nobody knows who he is.
Max, I just want to give a shout out to Citrini because Citrini was very bullish on this name Teradyne, which he realized that Amazon was making all these robots and the robotic arm was made by Teradyne, and then actually the Teradyne factory was right across from Amazon Robotics or a headquarters of Amazon. And so he put out a big bull call, and immediately Goldman put out a short report, or not a short report, excuse me, a underweight call. They reduced a sell rating. And so it was like, who's going to be right, Goldman or Citrini? And I happened to do some research into the name, and if Citrini recommended a stock that I didn't like, or an industry I didn't like, or they weren't buying back stock, I never would have get involved. But I did see they were a profitable company, consistently profitable, buying back stock, good strong balance sheet and the like. So I bought a few call options, and the stock is up 20% today. So just want to give a shout out to Citrini, and also with FiscalAI, you talk about different segments and different products. It's true for Teradyne, and it's also true for NVIDIA. You could see, what is traditional for NVIDIA's traditional, their car business and their traditional like gaming business. Their revenue is now a tiny fraction. Like it's all in the data center, all in NVIDIA's data center. So if there's going to be a phase 2 of AI, which I think there is, it's going to be in robotics. Like NVIDIA's robotics revenue should probably pick up, and Teradyne's robotics revenue should probably pick up. So that's just yet another thing you can see on Teradyne, on FiscalAI, and it really helps to visualize it and see it clearly. And these are the type of things that, yes, you could technically do in Excel yourself, but it just makes it so much easier, and you really gain an understanding when it just kind of clicks and you just see it on a chart. Even the cash flow statement, like just the way it's so dynamic and how you can just instantly pull it up, it's really easy to use and very intuitive. So can't say good enough things about it. And I believe there's a 2-week trial. So yeah, people get 15% off and they get a 2-week trial. I believe the link is fiscal.ai/mm. Is that right, Max?
That is correct.
There we go.
You get a 2-week trial, and then they have different tiers depending upon whether you're a professional investor who might want to have the ability to download that data and do your own models in Excel. They have that enterprise level offering, and then they have something that's more for people like you and I.
Yes, they do different tiers, of course. And final word on Chinese equities. I feel like China is a big question mark in the tariffs. I feel like a lot of, not necessarily President Trump, but the people around President Trump, who are the intellectual MAGA consensus, they have a view, like Oren Cass, who I interviewed, one of them. Not that he's particularly around Trump, but he's very involved in Republican politics and new Republican politics, that basically they want a 10% or a 15% tariff on the rest of the world except for China, and they want to go really, really hard on China. I don't know if the actual president wants that. As someone who's very long and has been long Chinese equities, I guess maybe my bread is buttered by Trump going easy on China. But I think that kind of is that could happen, but we'll see. So much question mark, so much uncertainty. But I guess, as the Federal Reserve noted in their statement, less uncertainty than a month ago. And when uncertainty is priced out of the market, that tends to have it go up.
Yeah, well, it's not like, Jack, I know the Chinese companies that you're invested in. It's not like they're heavily exposed to tariffs, like Chinese fintech consumer companies that are lending money to Chinese consumers are not being tariffed.
In a fundamental sense, they have zero exposure. I mean, even Alibaba's like exports to the U.S. are quite small. If the fund manager who invests in Alibaba, I think, which is kind of the stock of choice for Western fund managers, is they see a headline about a huge tariff on China, they're not buying Alibaba. I'll tell you that.
Yes, indeed. But I do want to call back to actually what you said about Hunterbrook and Citrini. And when you saw that you were so focused on Teradyne and the robotics trend, on the other people's money side, I was like, ooh, Hunterbrook, that is such an interesting investment business model. I don't know how many listeners are familiar with them, but Hunterbrook actually is the investigative reporting firm that is also hedge fund. So similar to the activist short selling model, where you're going out, you're doing research, you're uncovering things, you're not publishing material, non-public information. And I think that that's maybe a misunderstanding that a lot of people have. They think just because information is new or it's never been synthesized before, it's MNPI. MNPI has a very specific definition.
That's a good point. And in the same way I kind of nerd out on macro and financial plumbing stuff, if you nerd out on hedge fund and especially raising money for hedge funds, Other People's Money, Max's show, is the show for you. Other People's Money is on Twitter. We'll, of course, include that. Max, you're on Twitter. I'm on Twitter. Jack Farley 96. We will leave it there. Thanks for listening. Looking to check out FiscalAI's innovative equity research terminal? Get your 2-week free trial and 15% off your first year at Fiscal.ai/mm. Until next time.
Thank you. Just close this door.